Hi, everyone. Welcome to the weekly stock market update, another packed edition for you over here. So let me get started because there's a heck of a lot of slides that I've got to get through. Let me know that you can indeed see and hear me absolutely clearly. And as soon as I know that's the case and where you're from, and if it's your first time, and then I will, let's share the screen right now as well with you. So you'll want a cell phone where you can take some shots of the slides that I'm about to share with you as well, because there's quite a bit. Sunny Cardiff, yeah, I know, I hear for you. I hear you. New York, fantastic. Good to hear people from outside the UK as well. We often have some New Zealanders. So if we can get New York to New Zealand, we're laughing. Right, you should see the slides on there. Let me also know if this is your first time. Now, as you all settle in, grab yourself a drink, something to do the screenshots with some of the stuff. I thought I'd share this. There's the settling in period initially, isn't there? As well, I thought this was hilarious, and this is actually true. He actually wrote this. It's not a meme as well. And I hear you, Rocky. I hear you. I got this one as well. This is my highlight of the week. Before I get into inflation figures, boo. Can you see Montrose? My first time. Fantastic. Jamaica, Bedfordshire, Hampshire, Bognor Regis, get away, Dale, bringing up the average up there, aren't you? Norway, blimmin' out, we've got more people outside the UK than we have inside. That's great. I love this. Sorry, I've hardly been in touch since joining the Great Investments Program in 2021. I watched your videos today, give you an update. I started with 100,000 to invest in 2021. It started off rather rocky, but today I've got nearly 400,000 basically in the portfolio. He added a bit of that to there as well. And he said, I don't have any specific questions to ask you, my favorite kind of student. So I won't waste your time with a scheduled call, but wanted to let you know I'm still here. I'm watching and learning. And most importantly, to say thank you for helping to change mine and my family's lives. I got that at 10 o'clock on a Friday evening. You can imagine I was over the moon. And he's had 2 babies as well in the past 3 years. So he's been very busy, and it's perfect time to have boosted his portfolio. Anyway, I thought I'd share that. I've got further updates on my thing with the Financial Times. That should be by April the 19th, next Friday, should all be going live. So things to watch and see. So do keep an eye on the Telegram on that. Now, things that have caught my eye before we do the stock market update. It is this Estonia, phenomenal. Pembrokeshire, everyone in Britain is just talking about how awful the weather is. Somerset as well. Auckland, New Zealand, we have got New Zealand covered. So everywhere from New York to New Zealand, I'm over the moon. That's fantastic. The S&P is finally beating the NASDAQ 100. That rarely happens, but I thought I'd just share it with you. There's nothing much to take away from this. Other than just to point out an unusual phenomenon. Also, what caught my eye, and I think I've shown you this before, is when the S&P has 5 straight up months greater than 20%, then 12 months later, it's still up 100% of the time in the past, though history isn't bound to repeat itself, about 14%. So any wobbles, I bear these little things in mind. April does tend to be a good month historically in the S&P and the NASDAQ. But again, none of these things are guaranteed, and we mustn't be fooled by taking a relatively small sample set of just 3 or 4 years and extrapolating from that too much, even though I guess the recent past is more relevant than, say, 1945 April, of course. But nevertheless, it's quite reassuring to see what's happened in April in the past. I mean, obviously 2022, and I'm going to come to 2022 in a moment, and how we avoid some of those big drags on the market in a short while. I will come to that as well. Sadly, not so good for the UK markets, and this individual who's in the markets is a little bit worried about the fact that there haven't been enough IPOs and quality companies are decreasing in number. And I think we know that to some extent. Barry, welcome from Pinner. Market corrections. Now, this is not to spook you and make you think, oh my God, Alpesh, is this a hint? We should be waiting for a market correction. It's just to say, since the Second World War, 26 corrections have averaged a decline of 13.7%. over 4 months on average, and have taken 4 months on average to recover. Not too bad. But of course, it does feel a lot scarier when you're in the middle of it, obviously. Okay. But I just came across that and I thought I'd share it. Again, no action for you needed. It's just to point out these things are common, they happen often, and so on. What I found, and I've shown this one before, but I do like it, and that's why I wanted to show it again, is the frequency of rolling 2-year S&P 500 returns since 1950. Average positive return, 32%. I think any of us would take a 32% rise over 2 years in our pensions any time, wouldn't we? And those happen 88.5% of the time. But actually, that's not what concerns me so much. You might think, oh, well, that's what I see what you're saying, Alpesh. No, that's not what concerns me. What part of what I'm going to do in this webinar is talk also about, well, how do we avoid the negative? Not completely avoid, we won't be able to do that. Negative returns 11.5% of the time. What if we could just halve that, so we're only there 5 or 6% of the time getting negative returns? And what if we could halve the average negative return to just say minus 9%? Hopefully 0, but say minus 9, because they will happen sometimes. Then these really do bite in a very positive way into our pension. So I'll talk about what we do, and the best example I can give you is what happened in 2022 and how we sidestepped those falls, which fund managers can't. Somebody said to me, why don't you create a retail fund? And I said, well, the problem with creating a retail fund is I couldn't go into cash in 2022 when I would have wanted to, because as a fund, you can't just sell all your holdings, say you're a fund, and charge everybody to be holding cash. The regulators don't like it. They, in fact, particularly dislike it if you happen to do that. So that's one of the key reasons why a fund doesn't make so much, a retail fund doesn't make sense, because you as a private investor have a far better advantage, which you can go into cash. And I'll come back to this a little bit later in terms of protecting your downside and how we did it. And if you look at this, this is Meta. That 75% drop and protecting yourself by going into cash. A fund can't do that. They might be able to sell out of Meta, but they'd have to buy something else. And if the market's falling, they're still going to get crushed and drag your pension down with them, which is why so many fund managers did so poorly then and lose 6 years of your pension. Look at that. At the bottom, you've lost 6 years of gains. Okay, all in 1 year. 6 years in 1 year. So I'll come back to how we want to avoid that, but still capture this. Because, of course, over those 2 years, you could say, well, if you just held it from January to December across 2 years, you would have had, well, a 0% return. Well, actually, no, you would have, yes, had a 0% return when you could have had a 276% return by getting into January of the second year. So how do you know when to get in? How do you know when to get out? And I'm going to touch upon that and keep it simple. So it's not open to interpretation, which is the best kind of investment strategy. It's the one which is more mathematical, so it's easy to do and not complicated. Okay, so we'll touch upon that in this as well. This caught my eye a little bit. It's, again, nothing to worry about in terms of companies. All it's saying is because of higher interest rates, more defaults are happening. More companies are unable to pay their debts. It's sort of peaking up a little bit, and that, again, nothing I'm going to read into this at all, other than, okay, just keeping an eye on it. That's all. Don't over interpret. This came from Money Week. Again, before I get into the stock market update, just the things which have caught my eye first. This came from Money Week as of 1st of March 2024. 3-year underperformance of these various global funds, Japanese funds, UK company funds, North American ones, European ones, Japan ones. And you might say, well, why do they underperform? And there's two main reasons fund managers are underperforming. And it's not because they're stupid. And I mean, forget the IFAs. They just sit a multiple choice exam. I'm talking about the underlying fund managers. And it's not because they're stupid. It is because, first of all, when the market falls, they cannot do anything other than have to hold those securities and go lower, because, as I said, they can't sell and go into cash. And of course, when it's rising, like here, let's say, they won't have too much money in any individual stock, because they'll say diversification, blah, blah, blah. And so when something does go up this much, it won't make much difference to your portfolio because they'll have sprayed and prayed into so many different stocks that when they do accidentally get it right, it won't have moved much. So that's why you get time and again all this underperformance. Most of you will be very familiar with it, why £100 over 3 years in a Baillie Gifford Global Discovery Fund is halved, and so on. And of course, if they get one bad year, sadly, the way mathematics works is if you lose a Scottish Mortgage Investment Trust at 50% in 1 year, the subsequent year, a 50% rise in your fund won't help you. You need to double your money the next year because 100's got to come 50. So you need to get 100% return on that. Okay, just how maths works. So that's why over prolonged periods like 3 years, they're more likely to underperform. They might get lucky over 1 year and say, oh, look at us. Since October, we've done rather well. But over, and these are big brand names. I mean, Aegon, AXA, Baillie Gifford, and so on. Anyway, enough of that. I thought I would also, in this cover, just some of the special situations. County Antrim, Northern Ireland, welcome, Alex. Cover some of the special situations which I haven't yet finalized for my Great Investments Program private clients. So these are ones which I'm still finalizing, but look relatively good. Okay. And they look relatively good based on the fact that value growth income. So we know undervalued companies do better than overvalued ones. Growing ones do better than ones which aren't growing. And dividend yielding ones do better than ones which don't. But there are exceptions, and it's not guaranteed to lead to stock price moves going up. But it's more likely to. And value is twice as important as growth, which is twice as important as income. And we've also looked for ones where the momentum, the monthly momentum, is rising. So this is not definitive yet. This is work in progress. I'll give the final list to my private clients, of course. But these are the ones on the short list for April as what I call special situations, ones which tick a lot of the green boxes, not necessarily all of them, for my criteria, and rising momentum. And Levi Strauss looking great. That one actually was in the portfolio for my students and at the start of April, and it's still there. And it subsequently moved up 16% in a day, actually. I think we had it on our portfolio on April the 1st, and then I think April the 5th, it moved up 16% and still looks attractive. Anyway, so we've got these. These have yet to be finalized. Alliance Bernstein has got to be finalized yet. But these are the ones which I thought I'd give you in this webinar, a short list of ones looking attractive. Hilton Foods, I told you need your phone. CNC Group, like I said, on the Great Investments Program, I'll give the final definitive count on these to the various to the clients. Cairn Homes, some of these might drop off when we do a deeper dive into them. There might not be enough upside on them. For instance, this might not have enough upside, and we might say, look, you're only going to make 20% in this, so let's leave it. And that'll probably be the major criteria we'll use. We'll just have to look at some projections, or we might just look at track record and say, well, actually, it's fizzled out too often. Let's leave it. Look, it's probably not. So, like I said, some of these might get removed. There's Man, and the main reasons I said they might get removed from this final list of good ones is either there isn't enough upside potential here to give an enough rise in the price, or in the past they've just got a track record of fizzling out. Anyway, so those are those. Let's have a look and get a more of a market update as well. This is the price earnings ratios. So it is $31 is what you're paying when you buy Microsoft stock for every $1 of future expected profit. So it's very expensive. That's why it's in red. The cheaper companies like Verizon, you're only paying $8 for every expected dollar of future profits. So why wouldn't everybody just buy the cheap companies and do incredibly well? Well, that also shows you why only having value funds is a problem, because actually, when you look at this, you'll realize, wait a minute, Alpesh, over the last 12 months, weren't the ones in red the ones that did the best? Yes, which just shows you that valuation is not the only factor. One has to look at revenue growth, profit growth, cash flow, and so on, and not just valuation, which is why when fund managers say we're going to look at, when fund managers say, oh, we've got a value fund, it's ridiculous because they're ignoring all the other important information, and they're almost certainly going to lose you shed loads of money. So that was an important factor I wanted to share it with you. Let's move forward. And as you know, these are the various factors that I look for in value, growth, income, cash flow. I'm just going to check something. No, I think we're fine. I just wanted to check something that I wanted to share with you all on this. Now, we therefore want to tick a variety of boxes, those boxes being value, growth, income, as you can see here, cash return on capital invested. That comes from Goldman Sachs Wealth Management. Companies in the top quartile generate 30% per annum in stock price movements on average. Not every company, not the whole basket every year. Momentum comes from the hedge fund industry, and Sortino and Alpha do. And those of you who'll be familiar with this, just to remind you, Alpha, the market goes up. If you've got alpha, you go up more. If the market falls, you also go up more. Well, you want to have alpha as a manager, so the best way to do that is pick a load of stocks which have alpha. Okay, when people go, oh, you just can't beat the index. Well, actually, if you just pick alpha stocks, naturally, by definition, you're beating the index, because what you're doing is you're picking stocks which, when the index goes up, they go up more. When the index falls, they still go up more. You just look at the statistics of the stocks. Now, the stocks aren't guaranteed to do in the future what they did in the past, but it's a pretty bloody good bet that they will. So that, especially when you combine it with Sortino. Sortino is high average performance. What's the average performance? Easy to work out. Versus the risk of missing it. So you want a very low risk of missing it. So you've got greater probability of hitting that average performance that you've had in the past. That consistency gives you a higher likelihood of persistence of performance. Combined with alpha, boom, you beat the index. Okay, Sortino plus alpha. And you might say, well, why don't people do this? I don't know. Ask the bloody fund managers. The retail fund managers won't even know what the Sortino is. They're still using a 1956 measure of risk and reward called the Sharpe ratio. They're that ignorant. I think it's because they all have a multiple choice exam to get qualified. Past week, well, this is what happened. You can see some of the tech coming off. We'll come to NVIDIA in a minute. I don't talk about things like sector rotation because I'm looking at companies. I'm bottom up, not top down. Look at individual companies. Those who say, oh, well, I think there's a rotation into healthcare. Well, no, there isn't. Not last week anyway. What can I say? There's nothing much to say about this. Let's dive deeper. It's a hodgepodge of stuff, but it proves the point. Just because it's cheap doesn't mean it's going to go up, and just because it was expensive doesn't mean it's going to go down. It is other factors in play: value, growth, income, cash flow, Sortino, all of those as well. Okay. Monday, Monday, the views are the same. I don't change my views day to day. If I'm holding it, I'm holding it. If I'm not holding it, I'm not holding it. ETF 1 month performance. There's going to be another video I'll do at some stage on exchange traded funds, but you can see how some of those have done. Year to date, S&P's up 9, Nasdaq's up 8. The UK markets unusually are doing better than the Dow. That rarely happens and won't last. So there we are. And what's been leading the way? Energy. This is the bit that people often miss. It's actually been the energy stocks are the ones which are leading the way, followed by communications, financials, industrials, basic materials over there. And then bottom of the pile, sort of in a way, is tech. So tech's not really been the driver this year. And that's important to know because our portfolio as well has not been just, oh, let's just buy 7 of the tech companies and that's it. Like last year, you could do that. You could even do 2 times leverage as well. Multi-choice or multi-guess exams, exactly. Thank you. Now, we didn't at the start of the year look at this and think, right, where should we put our money? It's a horse race. Let's go to the bookies and put our money on energy. I didn't know it's going to be energy and communications, which would do well this year. I mean, you could have said, you should have known, Alpesh. You said they're cheap. How come you didn't know? Well, I said they were cheap. It doesn't mean they're going to have the momentum. Momentum's different to value. Okay. So how do we even capture that? Well, because we look at everything. We look at the value, growth, income, cash flow, Sortino. And if some of those ended up being energy stocks, great. We ended up with energy stocks. communication stocks like Verizon, then we ended up with communication stocks. So be it. And tech, well, then we ended up with tech stocks. So that's what I mean by bottom up. 2 times leverage means this. If Microsoft goes up 10% and you've got 2 times leverage exchange traded fund, which trades like a normal stock on Microsoft, then then you go up 20%, 2 times leverage, you go up twice as much. If Microsoft drops 10%, you lose 20%. It's a bit more complicated than that. And of course, as you can hear from that, it's dangerous as well. So my son has 2 times leverage in Microsoft, Apple, Microsoft, Meta, Apple, Amazon, Alphabet. But then again, he started last January in those positions, so he's holding on to them. He wouldn't necessarily do them now, and I'll come into those a little bit later. Why does he have 2 times leverage? Well, because he's 6 years old, and in a junior ISA, you're only allowed about 12,000 a year into it. So to double that impact on his portfolio, 2 times leverage for him, and he's young, willing to take extra risk, it's worth it. Or rather, his dad told him what to do. What's been driving this growth? Well, it's been growth stocks, those growing in revenue and earnings. Luckily, we have those, as you know, because what we do is we pick companies which are a subset of a subset of a subset of a subset. So we pick companies which are not just value, not just growth, not just income, but value, growth, income, and momentum. That way, whichever of these things is winning, ours should be in that subset. Because after all, if you start off with 10,000 and narrow it down and end up with 200 to then look at in great detail, I'll come to that, I'll put that up on screen in just a second, then you're able to do that subset. But if you say, as many fund managers do, we're only going to pick UK FTSE 350 companies, so we're only going to pick from 350, then you can't have a subset of a subset of a subset, because you just won't have any choice. You haven't got enough. I'll give you an example of what doesn't make the pick. And after all, it's my son's inheritance and his and my retirement fund. So none of these make our criteria, because they're not green across all facts. They come close, some of them, Glambia, but there's better companies by value, growth, and income. So you can see why a tight criteria might mean that there's a lot of companies you leave out. Now, let me put it this way. Let me tell you what we're doing so you're not confused. Out of 10,000, we pull up the data on 10,000 companies from the London Stock Exchange. These can all go in my SIP or ISA, New York Stock Exchange. What we're trying to do, if I put it into a metaphor, we're trying to throw the bathwater out, and we don't care how many babies go out with the bathwater, i.e. we're trying to throw out the bad companies' bathwater, and we don't care how many babies, good companies, go out as well, as long as what's left in the bath is very little dirty bathwater, bad companies, and enough babies. Now, that's very different to saying, no, we have to throw out all the bad ones and only keep the good ones to choose from. That'd be an almost impossible task. We don't mind if we get rid of a whole load of good ones, as long as we've got enough good ones left to be in our portfolio, and very little bad ones. So in effect, people think, oh, you're just trying to pick good companies. No, we're actually trying to not pick bad ones. Does that make sense? We're trying to not pick bad ones. Most people don't look at it like that. Because they don't look at it like that, they don't appreciate that their job is almost impossible if they don't look at it like that, because look at how many bad ones there are. And by bad, I mean there's just a lot of negatives on their financials. And if you don't believe me, go down your high street or go speak to a businessman. Consider this: 90% of all businesses fail within 3 years. Business isn't easy. And having good companies doesn't mean they're the only ones on the stock market. There's a lot of companies which just simply aren't that good, let alone for the fact that you can have good companies which are dragged lower 1 year and the next year they shoot up, like Meta, down 80% 1 year, up 250 the next year. So we're just trying to avoid the bad ones. Okay. Market, I think I did that one, didn't I? This just for information, top 10 S&P stocks over the past month. It's just purely for information. I did consider copper exchange traded funds. I tend to leave the sort of things outside of equities more in years like 2022, when the markets, when there aren't good stocks, really safe, good stocks to pick from. Then what I'll tend to do is look at exchange traded funds to try and top things up. But so this year I'm late to the copper party, and I'm not really had a chance to look at it, so I'm not going to say anything about copper ETFs. And I'm not a gold specialist. I'm not going to look at those. Bottom S&P over the past month, you can see, just for interest, the top FTSE 350 out of interest, and the bottom ones as well. I'll check and have a look at it a bit. S&P 500, where are we on this? So there's a couple of things I want to teach you about this, okay? And one thing I've already taught you, the other thing I haven't taught you, or haven't taught you in this way, and I think it's really important. So we think this should continue going in this direction. We're still pretty comfortable with it. Yes, but Alpesh, what about these little pullbacks? How do you know when something moves lower like that? How do you know whether it's going to continue lower or whether it'll go up? Well, what do you mean by no? I mean, we don't have a time machine. How do we play the probabilities? Whether it's going to go after initial fall in direction A or B. Now, here it went in direction A, as you saw. Okay. Here, of course, after initial fall, it went in direction B. That was 2022, famously. So, Alpesh, how do you know if something's going to come back, as you've put it, Joseph? And Dominic, I'll come and answer your question in a second. And some of these other Sylvain, I'll try and answer probably more at the end, so I'm not too slowing down. So how do we know if something's going to come back or not? Now, probably the easiest and quickest way for me to do that, whether it's going to be an A or a B scenario, and I've written about this again, as I say in my books, is this. If the monthly, there's the monthly, there's the weekly, okay, you can do all this on Yahoo Finance, right? If the monthly MACD is rising and the weekly is rising, all right, so let's go back to here. Then you're going to get the biggest up moves usually, all right, during that period. Now, if the monthly MACD is rising and the weekly is falling, then usually you're going to get a scenario A, like this, okay? If the monthly, I'll say it again, if the monthly is rising like it was then, and even just dropping a bit but not crossed its own moving average, but the weekly is falling, i.e. they're going in opposite directions, then yes, you'll get that dip, but it'll probably bounce back. If, however, on the other hand, they're both falling, like here, okay, then you're going to get an initial fall, which will be like position B, and it'll continue falling. Might have a little bump up there, but it'll continue falling. Now, that's how we knew to stay out in January 2022, because not that point, not January the 1st, although in January the 1st, I said I'll wait for the February list, but really because when this happened and it crossed below, that really confirmed everything not to be in, and wait till February. And then February, we waited till March, and we do the lists every month to hold for 12 months. And we said, well, we'll wait till April. April, we said, we'll wait till May, June, July. And it wasn't until July we got some energy stocks. Anyway, in 2022. So that's the simple education, all right? Whether you know it's going to drop or rise. Now, not know for certain. This isn't guaranteed. We're talking probabilities, but it gives you enough of an edge, So anyway, that doesn't even apply at the moment over there. But some of you have asked me about CVS and Dollar Tree. So go look for yourself. Basically, is both the monthly and the weekly falling, in which case, and by falling, I mean, has the monthly actually even crossed below its moving average, in which case, bad. And it hasn't for either of those, by the way. I'll tell you the answer now. So they're just going through a periodic move of those. All right. So that's how I determine it. Now, there's another thing to do. Whenever this is rising, you can look back and you can say, what's the drawdown danger, DDD? Which basically means the depth of fall from peak to trough on the upward trend and the duration. Okay, so depth, duration creates a little square, and you know, oh, okay, that's pretty normal. So you might say, well, Alpesh, I've got to wait a long time to be in there, and what if it will continue falling? Well, what you would just simply do is, had it crossed below its own, the weekly was falling, but had the monthly fallen below its own moving average? No. Well, then we just hold, we just wait. Okay. Now, what if it did, Alpesh? Well, then we would have exited. Yeah, but then we would have lost all of that. Yeah, well, if you want to try and anticipate things and you're risk averse, then you probably just ought to have smaller position sizes or just get out earlier. But on the whole, we have to wait. And sometimes we take those on the chin and then thankfully it goes up. So that's it. Okay. So I thought I'd give that as an example. Anyway, where are we on the FTSE 100? Well, I'll probably go up a bit, but it's going to run out of steam. NASDAQ, this is the monthly. It's got a little bit more room, I would have thought. However, you've seen those drawdowns and the durations. They can happen. So do not be surprised if we get a down month or even two in an upward trend. Because look, here we've had, so I wouldn't be surprised. Nothing to do, by the way. There's no action to be taken. Most of the time you look at this, you observe it and you go, okay, fine, thanks. I've just got to wait. Like with Apple, okay, I sold 50%, as you know. When did I do it? A couple of weeks ago, was it? A couple of weeks ago, because the monthly MACD was below its own signal line. And of course, the weekly was falling, which suggests that there'll be falls. And that's it. So I continue holding the other 50%. I wouldn't buy more now. I'm not selling any more at the moment, but let's see what happens on Friday. It seems to be holding for the moment. I know the markets have taken a bit of a beating again today. Okay. Alphabet, great investments program only. Microsoft, it's toppy. I wouldn't buy at the moment only because it looks like it might be a bit too close without much room to go to the upside. But I continue holding what I've got since then. And my son continues having 2 times leverage ETFs on Microsoft in his junior ISA. So he, during that period, has made about 100% return. Why Microsoft, Alpesh? Why did you do only 2 times leverage and not more? Well, because leverage is risk. And why Microsoft? Because the volatility is very small in Microsoft. It's one of the safest companies there is. In other words, when it's rising, it doesn't tend to have massive, big, fat drawdowns. I mean, you might say, well, that was COVID, though. You might say, well, surely, isn't that a big one? Yeah, that's a big one, but it wasn't one which we were worried about for the simple reason that whilst the weekly had topped and was dropping, the monthly didn't cross below its moving average. So fine, no need to worry. That's it. What do you think, Alpesh? Well, no need to worry. And by the way, during that period, I did not read a single article about Microsoft or any news items or anything about AI, just so you know. I didn't get any whispers from people at Microsoft going, psh, you know, we just came out of a board meeting and this is what happened. Nope, none of that. So it was just based upon that. It was just like, okay, we'll wait. And you can go back on my telegrams and see in any event. Amazon, great investments program. Disney. So now it'll get a little bit easier. You can see the idea, can't you? So there. Do look on YouTube at my videos on the poor performance of funds and why they do it. So Nvidia is a good example of one which we've had since January of 2023. And normally we hold things for 12 months. Why did you hold this longer up? Why did this break the rule? Well, because it kept bloody giving money up. So what, we don't automatically sell it. I mean, it's just giving too much money. Now, if you watch my broadcast here, I did say on these broadcasts at that time, this looks toppy. It looks like it's peaked. It could fall any moment. But because it didn't fall, remember our rule, 25% from the high since we bought it, or even if it drops X percent, like 5, 10, 15, 20, then sell Y. None of that ever got triggered, even though I said, look, it's overbought. It's bound to fall at some point. It just didn't. So we just stayed in, and then it just kept giving us more money. So put in simple terms, bought it here. We said, well, we'll wait for it to drop 15% from the high before we think about selling even 50%. Nothing ever happened. So every time we looked at it, it was like, okay, giving us more money, giving us more money. Oh, it's going sideways for a bit, but there's no reason to leave. The other way I put it is, when the goose is laying golden eggs, you don't kill it prematurely just because some point in the future it might stop laying them. And it might stop now. That might be it. Because look, but that would be a bit premature. I'll wait till Friday before deciding whether to sell anything on that. And whether I'll sell it will depend upon a very simple mathematical rule. If it drops 10%, then I'll make the decision whether to sell based on my risk appetite and my son's. 10% of it, 20%, 30, somewhere between 10 and 100%, basically. Okay, very simple, very simple. And if you want to know, well, wait a minute, where are all of these rules you have? Well, very simple. There you go. There it is. What do I do with my portfolio? Watch my monthly broadcast. There. Is it 12 months? Has it been under 12 months? Yes. Has it fallen 25%? Yes. Well, then you just wait. Are you risk averse? No. Well, then you wait. If you are, because the MACD monthly has crossed below its moving average, then sell. Otherwise, like I said, most times you've got absolutely nothing to do. You've got nothing to do. As Warren Buffett often says, there's absolutely nothing to do. Now, Tesla, as you know, we got out in October because it was a special situation, which means it didn't quite tick all our green boxes. It ticked all the value, growth, income ones, but not cash return on capital invested. So we got out then because the momentum situation wasn't looking good. Anyway, after we got out, it kept going up. And we thought, oh, okay. And then, of course, it's dropped. The reason I'm looking at it in this presentation is you're going to see a lot of stocks now, which I won't necessarily own, like Tesla, but which, they set the market sentiment. So this is a market update. So they're more for that. Okay. Meta, I'm afraid, well, it's a bit like NVIDIA. So the same rules as NVIDIA. Great investments program. NXP, you get the idea. You know what the interpretation of this is. So we continue holding that. I continue holding Qualcomm. Service Now, great investments program only. The general rule, as I said, is 12 months. And if it's a special situation, if you ever hear me use that word, what it means is it didn't tick all the green boxes, but it certainly ticked value, growth, income, cash flow, and the momentum part. And that's often good enough, such as Intel did. It'll still get a good return. Again, let me make that point. What it means is that it was green on here and the momentum was strong and you can still get a good return. What does that tell you? Well, it tells you that these other ones, which are important but are not essential. They are important enough that I want them to be green, but even if they're not, the fact that this is green and the MACD is rising is important for me. Netflix, not one I own, as you will know, because I keep saying. So why am I covering? Well, we started covering it at this period after this big numbers rise, just to make the point there are companies you can get into quite late. I mean, you might say, have I missed the boat? 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 Even here, have I missed the boat? Well, no, clearly not. That boat just keeps sailing. Now it's looking a bit toppy because when it looked like that before, it fell off a cliff. So this is why you have a 25% rule, because look at that. Otherwise, you have all this time you go up and you lose 6 years of your pension in one go. Okay, that's why you have the 25% from the top rule. Actually, most of my students might not even wait for a 25% drop. In most cases, the 12 months happen before the 25% drop anyway. The 25% drop will probably impact, let's say a student picks 20 stocks to hold for 12 months. 2 of them might get impacted by the 25% rule. The others, 12 months will be up and it'll be time to get out. As I say, the exceptions being a Meta or an NVIDIA where it's just skyrocketing. So why would you just leave it? You'd leave it in longer, but that's an exception to the rule. So this I wouldn't buy now, overbought. I don't own any anyway. Do have a look, as I said, on YouTube. We've got 1.3 million views now, 1.3 million on my views on pensions and their poor performance on there. This is one I keep covering. I probably don't need to, but anyway, as I was saying, it's been popular with the hedge funds, and that should still continue going up there, even though you've got some weekly weakness there. Again, as I mentioned, if both the monthly and the weekly are going in the same direction, you're going to get the biggest rises. If the monthly moves up and the weekly falls, you'll get some temporary falls, usually. If they're both falling, especially if the MACD has gone below its moving average on the monthly, then you want to get the hell out of there. Okay, but if they're both falling, they might just fall for a short time. But if the monthly MACD falls below its own moving average, get the hell out of there. And that has been enough to make me a small fortune, right? So there you go. Great investments, 330,000 people now on there. Do have a look. Do have a look at all of these as well on my YouTube channel. The links are on alpeshpatel.com/links, and follow me on LinkedIn, where together with Bill Gates, I'm a top voice. And do have a look. I've got more to come. Don't worry. Do have a look at my campaign for $1million.com as well, which is to teach 1 million people how to invest better and increase their pensions over their lifetimes by 1 million. Over their lifetimes by 1 million through having a bit more knowledge on investing. Let me give you a bit of that knowledge on investing and answer your questions as well. This is one that I covered time and time again. 20% growth, just that low growth from fund managers time and again. This lady wrote to me and she said that's the poor return she's been getting. And it's just shocking how little return they're getting, because actually over 10 years, she got 20%. So she got, after 10 years, she only got £20,000. Whereas, of course, that alone, or even, can you all hear me okay, by the way? And the S&P 500 alone would have given us so much more. And why do I look at US markets? Well, I wrote about this in my very first book. Sorry, my very first Financial Times column in 1999. I'm selling all my UK holdings and only buying UK one. 1999, I'm selling all my UK holdings and only buying US ones is what I wrote in my first Financial Times column in 1999. And the reason is not because I foresaw the rise of the US, but simply because there was more choice. And I can't tell you anything otherwise, because you could just pick up the book from back when I wrote those columns and the book would have said the same. And you would say, well, actually, no, it wasn't because you foresaw AI, Alpesh, which is what you're telling us now. It's because you said you'd have more choice to pick from. And that's critical to success. I didn't come up with that. A Nobel Prize-winning economist who I used to write about in my newspaper columns called Eugene Famer said that. I mean, simple maths. He said, if you've got a bigger pool, you can afford to have more stringent criteria. If you've got more stringent criteria, you've got greater probability of picking quality companies. And if you can pick up quality companies, you're more likely to do well on the upside as well. And the reason fund managers have a big disadvantage, which I don't, is I can hold cash like in 2022. And if you look at 2022 and what happened, it wasn't just Meta. Meta is the most extreme example where the monthly MACD was falling and crossed below its own moving average. In actual fact, that same scenario had happened across Apple, Amazon, Alphabet, the S&P, and so on. So it became clear to step aside and hold cash. I actually thought initially 2022 was going to be a good year. So why did I think one thing and do another? Because thinking is narrative and opinions and biases. I do based on data. I looked at the data and I thought, oh, we better just wait till February. February, there were no good stocks. March, and so on as well. Steve, thank you. I know. I don't know about here, but it's quite easy to set up the MACD lines as Alpesh does on TradingView. Yeah, I mean, I hear, do you have to pay for TradingView though? Yahoo Finance is free. That's why I happen to mention it. I hear good things about TradingView. I don't happen to use it myself, but I hear good things. I don't know if you have to pay or whether it's free. It might be free, but I do hear a lot of people, they like TradingView, so I've got nothing against it at all as well. This is the letter we drafted for somebody who wanted to sack their IFA. Feel free to have a look at it whilst I look at others. Reading your trading cookbook. Could you do a video on MACD using Yahoo Finance? I have done that, Joseph. I have done that. I may well send you the Loom link on here to that. So I have done that on that. The big issue for me is 40% realistic? Well, there's certain conditions in which a 40% rise in your pension is realistic. And these are very limited circumstances, very limited. They are, if these first 9, ignore the 10th one for a second. These 9 conditions apply. First of all, if there is a market tailwind, like 2021, 2023, if there isn't and the market's crashing, you ain't going to get 40%. And you hopefully don't need me to tell you that, okay? It's just not going to happen. So the video on using Yahoo, I'm going to type the comment. The link is here, Yahoo and the MACD. I think you should be able to see that link and the video's there, okay? Oh, by the way, I should do a poll, shouldn't I? Here we go. Only if there's high Sortino. That means high average return in those stocks and very low risk of missing that return. So they've been consistently high performers. And alpha is if the market goes up, they go up even more. So if there's tailwind, they do better. And if there's headwind, they don't fall as far. Those are alpha stocks. So you're only going to get that kind of return if you've got high Sortino, high alpha stocks. You might get it by some miracle that you bought one company and somebody on Reddit talked about it. But that's like putting it all on red in Vegas or winning the lottery. We're talking about not sort of winning lottery types. You're not going to get it from the UK, I'm afraid. Sorry. Or emerging markets, and you only need to look at emerging market performance to know that. You're going to get it from US because you've got enough choice. It's not because I'm a America-phile, which I am, but it's just because you've got more choice. I used to work in the US Congress back in 1995. I was working for Elliot Engel. So I've worked out there as well. If you can go to cash in bad years like 2022, that is vital. You can't average 40% or even 30% if in the bad years you get wiped out. And let me tell you what I mean by that. So for all the people who believe in buy and hold, that year wiped out 6 years of your pension gain. This is Meta. That's an extreme example, I grant you. There's less extreme examples. And over 2 years, you got a 0% return. Now, why did we get back in January of 2023, which is on my Telegram channel? Well, because this and others were on my approved filtered list, which I showed you earlier, and the momentum wasn't falling. It was that simple. Did I know it was going to go up 250%? No, of course I didn't. If I knew that, I would have gone to Ladbrokes and said, make me odds it's going to go up 250%. I would have leveraged 100 to 1 on that one. Okay, so that was it. I mean, it's relatively simple. I had somebody today say, should I do this? Should I put moving averages? I said, I think you're overthinking these things. Paresh, who sometimes joins me on these and is co-author of my books, used to be a floor trader on life. And somebody mentioned the trading cookbook. The strategies in there, which are by Paresh, were all the strategies for a hedge fund called Marble Bar Asset Management, which went on to a $2 billion hedge fund. He did all the strategies for it initially. And I asked him, I said, why do people complicate it? It is a bit simpler than they think very often. But it's like most things. It's the experts who can simplify it because they learn everything and then they realize so much is irrelevant. If you monitor once a fortnight, yeah, you can't just buy and hold and forget because otherwise you might be dragged down a load. If good years make up for bad, like 2023 and 2021 make up for 2022, which was pretty much 0% return. If croaky stocks, that's what Goldman Sachs, those are the ones which Goldman Sachs Wealth Management said get you the 30% per annum. They're the ones with a high cash return on capital invested. Cash return on capital invested. I think I've got the slide later on in this from Goldman Sachs Wealth Management on that, which I stole and used. I took their research and stole it and took it. Look, Microsoft stole from Apple. Apple stole from Olivetti. Okay, so it's the way it is. If hold 12 months, then reevaluate. So you can't just buy and hold forever and assume everything always goes up, because otherwise you might keep your stock in something which has had its day basically and world's moved on. So you're holding for 12 months and then getting the data fresh again. Why would you ignore fresh new data, freshly cooked data? And if you sell everything, which drops 25% from the peak, those are very specific conditions under which the pension then rises. Very specific. Now, if from today till eternity, the stock market just goes down every single year, you will never get a decent return again. Okay, so here are some disclaimers. How did we do last year? And last year was such a good year, it may well never repeat itself ever again. In fact, I'm going to guarantee you it will never repeat itself ever again, because the safest thing for me to do is to guarantee you we'll never have a year as good as last year again. Right? Because last year was ridiculously good. The market was up 25% on the S&P. I can't take credit for that. I'm going to show you the stocks we had. They mainly, well, they are US, although we do the analysis on London Stock Exchange European, but I tend to buy from US. It's what I call my further filtered list, which is MACD Rising, which is what I talked about, the Quality 5, the 2 M's and 3 A's, Meta, Microsoft, Apple, Amazon, Alphabet, and the special situations, which, as I said, are the ones which are value growth income 7, 8, 9, or 10, or rising MACD. And anyway, this is from January to December, so it excludes any leverage, it excludes any stocks being overweight. Like, for instance, I have 2 times leverage in Microsoft and more in Microsoft than the other stocks. But generally, out of 20 stocks, I'll have 5% in each. But up to 15% in the Quality 5, not this year, because, as I said, I wouldn't add more to them than I've already got, because they're toppy in the case of Meta, Apple, and Microsoft, for instance, and actually sold half of Apple. Last year was not a typical year. 2022, most of it was in cash. Okay. And those were the ones. And you might say, well, that's very few stocks. Well, yeah, it does tend to be very few. With this program, this doesn't include the ones we bought during the course of the year, because during the program, I do buy during the course of the year for the students' sake, so they can see what's happening. But here's what's interesting that people don't get. The worst performer and the top performer, there's a massive variance. But Alpesh, if you're using value, growth, income, cash flow, Sortino, alpha, using the same criteria for all the stocks, why don't they all go up the same amount? Well, if they all went up the same amount, I don't even need to buy one stock. Even Warren Buffett has more than one. And the reason is there is an X factor in the markets. There is something which might be specific to specific companies. For instance, NVIDIA discovered that artificial intelligence is booming, and their chips are the things that came out, their graphics cards are the thing that came out during the course of that year. Okay, so there is specifics. When you say you hold for 12 months, is that from when the company gives their last year? No, from when I bought it. From when I bought it. I hold for 12 months from when I bought it. So if I did the April list, and let's say I picked from here, and I'm not showing you the filtered, obviously that's for clients, that bit, then I would buy from, let's say, April the 2nd, I'll hold for 12 months until next year. Okay, and then go through the fresh data again and pick again. So these are the ones. Last year was an exception. It was an exception because the market had a massive tailwind. Okay, so we've got to understand that, because in 2022, the same approach, we had to hold cash for most of the year. Because God knows, if I could get 80% per annum, I'd be the richest man in the world very shortly. So that's, when do you buy? When I feel like it, basically, is when I buy. So AI picks, there we go. Assume you plan to invest over 10 years. Let's say you make 20% per annum, not 40, but you just do 20. Let's say you got 100K in your 401k and so on. You plan to add that much, and that gets $1 million. That's what people are after. This isn't whatever happens. You know why? Because most times the market will do this, then it'll go down, then it'll go up, then it'll go back down, then it'll go back up. You want to be in a position where that 100,000 has become $1 million over 10 years. That's my job for my family, turn every 100 into $1 million over a 10-year period. So that in the 10th year, that's where you are. Put another way, this is the importance of performance. Let's say you did that. Let's say you started with 100-ish down here, sort of right there. Now, if your performance was 20%, you ended up with 1.7 million. If the performance was 10%, you ended up with 333,000. Now, that's a massive difference. That can't be made up for by just saving more and spending less. You know, the whole notion, well, my pension's lagging, what should I do? Oh, you could start sooner. Well, you need a time machine for that. You could save more. Great, I've got to be even poorer. You could spend less. Great, I've got to be even poorer. The easiest, quickest thing and the most impactful, not in the near term, here you can hardly tell between these three horses, is performance. And it's probably the easiest thing to do, which is why we go to all this trouble. We go to all this trouble and all this effort. Okay. Now, this initially was done just purely for me. It had only been made public more recently over the last few years because we thought, wait a minute, why don't we make this more public and teach more people? Actually, I've been doing it since 1997 when the very first book came out, which is over my shoulder. I've done 18 books now. And by the way, you can download Investing Unplugged for free from alpeshpatel.com/links. Teshbot, is DFS still a special situation? What do you mean by still? If it was once, then it was then. Then you hold for 12 months. So there's no definition of still. If it was, say, in January, then it is for 12 months. You're holding it for 12 months. You're holding for 12 months, or if it drops 25% from the peak. And if you didn't buy it then it's too late now because it was January. Okay, so you don't take old data and then apply it today. It's like I wouldn't go back and buy, I don't know, Ford Motor Company today because it was really good in 1924. Do you always set stop loss? Yes, Stuart, because and if that lesson hasn't been drilled home, because look at this. All right. That's why. You might say, that's fine, Alpesh. It dropped. I didn't need to do a stop loss because look, it came back and I got 0% over 2 years. Yes, you lost 80%. By the way, you lost 10, 20, 30, 40, 50. That's the point your wife puts the decree nisi in. 60, 70. That's the point the judge grants it and you're divorced. 6 years of your pension gone, 80% lost. Okay. Yes, you got 0%. But what if you could instead do what we did, which is get the 250% on that stock? I wish it was on the whole portfolio, but just on that stock. Instead of 0 over 2%, 2 years, you got 250 over 2 years. It makes a massive mathematical difference. And it's the mathematics which are important. It's not done like that so I can feel good. Oh, look, I missed that and did that. And, isn't that pretty? That's not why it's done. It's actually done because mathematically it makes a massive difference. A bit like this, a massive difference. Not a small one. If it was just, well, if you got all this trouble, take all this time, to be honest, it's 5 minutes every 2 weeks you monitor your portfolio to see if anything's dropped more than 10% from the peak. That puts you on amber alert. That's it. 5 minutes every 2 weeks. and it's your pension. Why wouldn't you? It's not just a 10 grand difference. You're talking over $1 million. That's why it makes a difference. It's worth doing. Okay. And to prove the point, so back in 2004, applying these techniques, that's me in the Financial Times column. And I came top in their competition to forecast the market. Near the bottom and just near the pussycat, pretty much in line with it, was Neil Woodford. Now, you might say, what kind of world gives the guy who narrowly beats a cat £9 billion to invest, and the guy who doesn't beat the pussycat and wins up there doesn't give him even a single billion? That was the year I launched the hedge fund, by the way. It was a Cayman domiciled Irish Stock Exchange listed fund. Wouldn't do it today. World moves on. I would never do it today. Do I regret doing it? No, but my God, anything in business is one of those things where when you look back, there's very few people who say, I don't want to easily do this again. It was a pain in the arse raising capital, going around basically begging for money. Hated it. Open a SIP and ISA. Very simple to open accounts if people don't know. It doesn't have to be Barclays. It could be Hargreaves Lansdown, AJ Bell, Interactive Brokers, Free Trade, any others, online. And then you can either do a wire transfer or you transfer your old pensions. There's all these brokers. I've used Barclays because everyone's heard of it. You can transfer your old SIPs to do it yourself. Interactive Investor do it. Hargreaves do it. AJ Bell do it. Loads of people do it. Okay, still Bruce from Woodford. Sorry, Pete. I know a lot of people are. Any suggestions for hedging against bubbles, which can take the whole market down? Did someone say AI? Mike, exactly what I've told you and what we did. That's my hedge against bubbles. I watch I do my Wednesday and Friday broadcast, and I look to see if the monthly MACD crosses below the moving average. That's it. And that was the same thing that I did on Tuesdays and Wednesdays. I used to have a Bloomberg TV show for 5 years, and that's the same process I used then. And if you don't believe that's the same process I used then, get the books that I wrote back then, and it'll show you. And I love the consistency of it. I wish I could say something like, well, yeah, of course there is, Mike. What you do is you speak to me, and I've got this amazing crystal ball and time machine in the corner of my office. But I can't, because the first thing you'd say is, I don't believe you. The second thing you'd say is, I looked in your books, mate, from 1999. You used the same process you're telling us. Yup. So that's that. And of course, to buy stocks, which some people are a bit afraid of in their SIPs and ISAs, it's very simple. Once you've got your online account, you put in Microsoft or whatever, buy £500 worth, and you click place a deal. Sorry, teaching you to suck eggs, I know. Just be careful of some of the big name funds. I mean, people think, I was with an expert, it's with a fund manager, can't lose much. That's 50% gone. That's 50% gone in 1 year. They now have to double the money that's left of your pension in order to give you your money back. And you must say, oh, that's fine, Alpesh. I missed them at that point. I timed it. Well, why don't you just time individual stocks then instead of funds? I mean, just do if you're so good at that. And these are the factors that I think are the most important. We can argue the toss if there's others you think are more important, but I'm pretty sure that covers it. That ends up looking at the P&L accounts, the balance sheet, the cash flow statements, everything's in there. Do you recommend spreading different brokers? Yeah, absolutely, Richard. Richard, Hargreaves Lansdown SIP do not seem to allow stop losses. No, they don't. Nobody does. Okay, you've got to look at your pension. Am I asking you to do something too onerous, or am I asking you to do something very bloody sensible, Alpesh? You look at your holdings in your pension once a fortnight for 5 minutes, my friend. It's your pension. I'm going to tell you something else, which is going to be earth-shattering. Nobody cares about your pension more than you do. Yeah, not your employer, not the fund manager, not the IFA, not me. I want you to look at your pension just every 2 weeks for 5 minutes. You do it on a phone. They make it so easy. All right, yeah, anything dropped 10% from the high since I bought it? Nope, no amber alerts. Fine. Is that too much to ask? No, because it's your money. Hey, I've got no conflict of interest with you. It's your money. I think AJ Bell have reduced their share dealing charge. £5, Ian, I don't care about, and I'll tell you why. In principle, I do, but let me tell you why. If I'm making 250% in Meta, I'm not about to liquidate my whole portfolio with one broker to save £2 on another. If I'm making a few £100,000 a year on a portfolio. Do you see what I mean? If we're making big percentages, we don't care about the £5 because we're not trading, remember. Have you looked at Siri lately? No. Do you recommend No. I think I've answered everything there. I've shown you this already. So value, growth, income, cash flow, Sortino, alpha. Okay, monitor infrequently, 12 months, 15 to 40 stocks, 20 usually, and 25% from the peak. You get the hell out of there. Okay, why 20 stocks? Well, 40 is an administrative burden, more than 40, and you're just really spraying too thin. You're not removing market risk. Okay, and you're more in line with what, let me just show you, which I'll just show you the portfolios of some billionaires. Okay, I'm going to go soon because I have got, whoops. I'm going to show you. This is from Goldman Sachs Wealth Management. It's not particularly controversial, but I don't think I've got 25 years retirement. I think it's very conservative, but I hold 90% in equities, and I probably will till the day I die, and 10% in cash. There's your 20% there, but there's the portfolio of the billionaires. If you want to take a picture, feel free. Don't copy it. I mean, he bought Coca-Cola when he bought Coca-Cola, which is in the 1960s. My point is, after his 8th holding, he's got less than 3% of his money in any specific stock. Here, he's got less than 2% in the case of Bill Gates after his 8th holding. So my point being, there's a degree of concentration. Feel free to take a picture. I'm going to take it down in a second. The point being that concentration is fine as long as you've got two things: the data, which they have, and the knowledge, which obviously they have as well. That's me at one of the book launches by Barclays. I've mentioned Barclays twice now. I don't have any affiliation with them whatsoever, just so you know. But they did one of my book launches I was most grateful for. And those are all the variety of books and so on. I've just shown you this, actually, haven't I? So I don't see. That's the Croquis chart from Goldman Sachs Wealth Management, which has been sort of game-changing, life-changing, actually, for me. I just happened to be at the talk by them and then took the slides. It was a talk for hedge fund managers back in 2010-ish or 2011. And 30% returns is what companies in the top quartile generate for their in stock price rises. Not every year, because look, in the financial crisis, none of them did. They got a massive hit. Okay. But you want stocks in the top quartile, which is what we filter for. This is a typical poor portfolio that we get sent in. If you want to send a portfolio in, alpeshpatel.com/links, there's another example. And you can have a look there. And this is somebody emailing me about having to sack their IFA and fund manager because of the spray and pray and investing in 1,000 different companies and not getting returns. As a result, remember, the NASDAQ was up 55% last year, the S&P 25%. That's not going to happen every year, but if you're not in a position to capture that, it's worrying. Again, another portfolio somebody had sent in. We then analyzed it, put it through ours, and found all these holes in it, which explained to us. Usual typical problems are underperformance due to overvalued companies which aren't growing, sometimes having too many companies, oftentimes having too many funds, and they're just getting very poor performance as a result. So we break that down and for them. So that became the Holy Grail vault, all of that, this basically. That became the first person I ever trained up. She used to be my secretary for 2 years, and then eventually from there joined immediately after my firm joined Newton. You can teach anybody investing, okay? But the point is, it's not brain surgery and it's not rocket science. So that was the point. The reason we made this public and more available, I first started a campaign to teach people how to invest better. And it was just followed on from all my books and everything else that I'd ever done, my TV shows, my newspaper columns. And then we thought, well, wait a minute, we could upend the asset management industry. Because what if we gave people this data, updated it, gave them the knowledge, then the 900,000 people who are unhappy with St. James's Place, which is a FTSE 100 company, could do better themselves and take control and use what the government wants them to use, which are SIPs and ISAs. Those are created for you to select yourself. They weren't created because they think it's a dangerous, bad thing to do. It is if you haven't got the data or the knowledge. So that's when we decided, well, if we create that, what if we can go global? What if we can get venture capitalists into it? What if we could even IPO it one day, like a St. James's Place, which, like I said, it's a $3 billion company in the FTSE 100 with 900,000 miserable clients. Well, I've yet to meet somebody who's happy with them, but I certainly have got dozens of emails, people who aren't, and that's just one of them. And when I go on, this is how I look at things. So, and we had great reviews from wonderful people from BBC and Coots and Financial Times, all the rest of it, on all of this, and great reviews from clients. Somebody put someone on the internet who's got a lot of reviews from Indians. I was thinking, not really. Should have, but I don't know. Maybe that's something against Indians reviewing things. So we launched it as a program for those who want the data. Otherwise, all the education's free anyway. Let me answer a few more questions. Is public? Yeah, you can just click on it. I think you can just click on it, can't you? Just click on it. Click on the link. Joseph, you've written is public. That's just how to use MACD on there. And if you want to be part of the program, and you don't have to be because I give these for free, these other webinars for free and all the rest of it. But if you do want to be part of the group who wants to be mentored directly and have access to the data for life, what we do for the first 250, I mean, the idea is eventually we're going to get venture capital funding in this and go even more global. We've got people from New Zealand all the way to Barbados who have signed up. I'm very happy indeed. If for the first 250, they just get, they pay off one-off. That's it. They just pay one-off. And in future, there'll be subscription charges for others, but not for the first 250. And the first 250 get me as the mentor, not anybody in the team, which will happen in the future. And we're still within the first 250, but it works. It definitely works, as in we've just got a bunch of happy people on this, so we're really pleased with it. And I guess the maths that people do is they say to themselves, wait a minute, if you can get me a 10% rise on my portfolio in even just 1 year, let alone the next 20 years extra beyond what I could have done, then I'll have made the cost of all of this back. And given it's a one-off cost, that's the calculation most of them do. And what most people want is not the online education that I've put in. I put tons of online education. They actually want the one-to-one calls with me, which are unlimited, and the monthly database. You might say, how can you have monthly unlimited calls, or unlimited calls as, you know, one-to-one? Well, because when they've got the data, they don't need to keep asking me anything. It takes them about first 3 months to settle in, learn to drive, basically. Once they've learned to drive, they might need the odd refresher. But you saw from that other person who said in 2021, I haven't been in touch for 3 years, but I've gone from 100 to 400,000. Thanks, mate. Although he'd put about 80 of his own money in there. So from 100 to 300,000, let's say. Thank you. Sorry, really been really busy, but followed what you did. And that's actually what we found happens, which is why I say unlimited, because I know actually it's not that onerous at all. And the data. So they want the data updated each month, and they want the access to me. So that's the plan, is to take all 900,000 of St. James's Place clients. Simple as that. Do you think that Jeremy Hunt is planning a raid on ISAs? I don't think Jeremy Hunt is, because I don't think he's got enough time. But I think a future government, I don't know of what color, will do this. They will say that money you take from your pension is going to be taxed at a higher rate. The amount you can put in tax-free vehicles is going to be limited. They're not going to up the 20K limit on ISAs. They're going to say, if you do take money out of an ISA, it's no longer going to be tax-free. It's going to be taxed at initially 10%, then 20, then 30, then 40. The reason pensions are going to get raided is because every single country which runs into financial difficulties raids pensions. They're usually Eastern European countries and Latin American ones that do it. We're going that way. Might not happen next year. Might not happen in 10 years. It's going to happen at some point in the next 20 years is the outlier. Worst case, near term, it's going to happen in the next 5 years, 4 years. Best case, it happens in 20 years. But pensions will get raided because they are the last bastion, unless we discover more oil suddenly off the coast. What they will do, and the best way is to raid those trillions in savings, and there are trillions in savings, is to say, when you take your money out, we're going to tax you 25, 30, 40, 50, 60, 70, 80%. Just increase the numbers. Okay. Or they'll say, if you've got more than $1 million, we'll tax you at a higher rate. And you can take the first 250 out tax-free, the next 250 at 50%, the next 250 at 90%, etc., etc. That's what's going to happen. Why? Very simple rule I have. If I've thought of it, Some son of a bitch somewhere else has thought of it. Best way to be part of the program if your portfolio is below. Mandeep, there's an installments program. So I tell you, my youngest person's 22, and he joined from the Royal Marines. And he just did the installments. They sort of work it out this way. What you do is you say 20% return on 500K, that's 100K you're making. And if that happens in 1 year, and we get a tailwind like last year, the price is going to go up again, I'm afraid. Part of the reason is, come on, the NASDAQ was up 55% last year. I've got some clients making 10 million a year, and they're like, Alpesh, this is a no-brainer. Anyway, that's the long-term plan, is to take all of St. James's Place clients. This works. You give the data and the knowledge to people, but they continue holding the assets. They continue being in charge of it, not taking their money, putting it into a fund, and then charging them fees for poor performance. No, that creates conflicts of interest. Those are the links if you want to be part of it all. Hope you will. There is a 40% webinar discount. Use that code there as well. And there's installments. So there you go. You are, by the way, the closest, DIY, you, the people on here, are the closest to be able to getting all the green ticks that you need to be able to do it right. Certainly not fund managers, and it's definitely not IFAs who are completely clueless, reading off old textbooks and regurgitating the same rubbish. They are so conflicted. Governments do need to give people an incentive to save, and ISA is fantastic. I totally agree with you, Steve. I absolutely agree with you, 100%. I totally agree with you. Don't tax it. Steve, if I was the Chancellor, I wouldn't at all. Governments do need to get, I totally agree with you. Yeah, I tell you, it's very simple. If I was Chancellor, I would have done what I said the Greeks should have done 10 years ago when they had their financial crisis. What was it, 14 years ago? They should have taken over Apple. And it would have, and I said it, 10 years later, they would have wiped out their entire national debt and continued providing them massive national income. Countries don't do it. And they can. There's nothing stopping a country doing it. Just Disney you can't take over because under legislation, they're not allowed. Darren, why don't you have a greater holding of bonds in your portfolio? Because risk appetite is subjective to each individual. So for me at 52, the joke I make is, well, I've got 2 private jets in my back garden, so I don't need to have bonds. I have individual stocks. I've got all the data on the stocks, and I want as high growth as possible, suitable to my risk appetite. Now, you might say, well, why don't you just have 2 times leverage Microsoft at the start of every year? You're absolutely right. I should, and I always joke about that at the start of every year. I'm in December, I'm going to say, I wish I did that. But there's a limit to my risk appetite. That's why. Do you think that Jeremy Hunt? Right. Okay, I'm going to go. I think I've answered everything. I hope all of that was useful. Do have a look at Campaign for $1 Million. If you want to join the program, you're more than welcome to. We have got over 200 people now on it, which I'm really proud of, and people doing rather well on it as well. You can have a look at alpeshpatel.reviews.com. I've got a dinner on April the 19th at Lincoln's Inn for some of my students. We do some free dinners for them, gourmet dinners, just so they know. Thank you all very much. I've overshot by 15 minutes, which means my wife might shoot me. So if I'm not here next week, it means, well, you know where to look, Mrs. Patel. Thank you all very much. And if there's any last minute questions, let me know. If there aren't, I'm going to send an email. So when you sign up, for those of you who signed up, you're going to get an onboarding email from me with all the links, and we'll set up our first call. Set aside about an hour for that call. Whilst there is great online education, people prefer the one-to-one calls with me in the tutorial, and that'll also give you access to all the data. What we also do is it's the equivalent of you becoming chairman of your own family office. So what happens is not only do you get all this data, which we then filter for you, but it's as if I'm working for you. So I give you I'm going to show you a monthly executive presentation, which is this. Okay, so that's the executive presentation, as if I'm presenting to you and you're the chairman of your investment committee board. And it tells you the stocks I would select for the next 12 months if you happen to start in April. And the reason for that, and the way it's done like this, is because some people just want the executive summary. Others might say, well, I want all the underlying data. That's in the Excel spreadsheet. So that's why I do it like that. So it's as if I'm working for you and giving you that executive summary. Do your portfolio spread equally between? Yes, Dominic, on spread equally, except for the quality 5 that I mentioned, where I might have upwards of 3 times in those. And I'm excluding here the leverage positions that I have on the ones in my son's junior ISA, which I mentioned. Scott, I only sold 50% because it's part of my quality 5. Normally, you're absolutely right. You should sell all of it. You should sell all of it. But in this case, I only sold half because it's part of my quality 5. Quality 5 are the ones that I expect to buy at some point again in the future. I have a predisposition that they'll be in my portfolio. So that's why. Okay. Thank you all. I really must go now. Really appreciate it. Thank you for all the comments. Yeah, anything else that you need in future weeks, just let me know. The comments, I think, will stay open for a while. I will read them later, but for now, I will say goodbye all. Thank you very much for being part of the webinar. Thank you.